So what is a pullback? A pullback is a temporary reversal or correction in the opposite direction of the order flow. A pullback is simply revisiting the range post breakup structure. So we're going to keep this simple and look at the overall trend of the market by looking at these major swings. And as you can see here, price is making higher highs, higher lows, higher highs, higher lows, higher highs, and so on. So where are our pullbacks? Our pullbacks are these corrections in the opposite direction of the market. So as you can see, this is a bullish market. We're looking at bearish corrections. So this would be another pullback. And this would be another pullback. So what are you waiting for during your pullback inside of your range? You're waiting for price to reprice from premium to discount or from discount to premium. So as you can see here, price broke structure to the downside. So you're looking to go from discount to premium. So you break your range into 4. Discount to premium, and you're waiting for price to reach premium and then sell off. So all your order block is a higher time frame representation of a shelf. So on a lower time frame, this is how your order block would look. You would see is a range being formed and a breakaway to form your order block. So for a quick explanation, here you have your higher time frame order block, which in this case is your daily time frame. And now we're going to go on a lower time frame, which in this case is 1 hour. And you're going to see that your higher time frame order block is a lower time frame shelf. Here you have your swing low, swing high, your range being formed, and a breakaway, forming your higher time frame order block. So in this lesson, we're going to talk about 2 types of pullbacks. Here you have a direct retracement, where price is in a hurry to reach your point of interest. And here you have your indirect retracement, where price goes through a turbulence phase before rejecting. And this would be your aggressive and compressive pullbacks. So let's talk about valid and invalid compressive pullbacks. So for a valid compressive pullback, what you would want to see is you would want price to start off with a compression to give you that compressive pullback profile. But once price gets close to reaching your shelf, and remember, your shelf is your higher time frame order block. So this is where the bulk of orders are. So remember, this is where orders are. So prior to price reaching this level, price is in a compression. But once price gets close to this level, you'd want to see an aggressive profile. You'd want to see price quickly get to your point of interest and reject. This would be a valid compressive pullback where price was compressing at the early stages of your pullback. And once price got close to your shelf, you've seen that aggressive expansion. So this would be your aggressive expansion. So what would make this pullback invalid would be price compressing inside of your shelf. So if price starts consolidating sideways, which is your compression inside of your shelf, you can expect your entry to fail and price grabbing external liquidity instead. So this would be an invalid. So let's take a look at this compressive pullback. So here you have your breakup structure. And what do you have here? You have your compressive profile. So you have this sideways consolidation. Price got tighter. Now let's locate our shelf. So the shelf would be right here. And by the way, this specific example would make a lot more sense once we cover the aggressive pullback, especially this zone right here. So keep that in mind. So this is your shelf, and let's locate our order block where you had the reaction from. So this was your order block. This was your last unmitigated order block. And if you pull your fib, you would see that this order block is in fact located in your extreme zone, in your extreme premium. So this order block is located in the correct zone. So here you had a compression, but once price got closer to your shelf, you've seen that aggressive expansion. In that aggressive expansion, then you got your reaction from your point of interest, which is your order block. So this was in fact a valid order block. Again, have a compression. Once price gets closer to your shelf, you wouldn't want price to compress inside of your shelf or around your shelf. You'd want to see this aggressive expansion into your point of interest to get your reaction. So an aggressive pullback is dependent on your distribution. So how price distributed from your shelf. So once the shelf was formed right here, you're looking at how price was distributed outside of your shelf. So if it was an aggressive distribution, expect an aggressive pullback. So an invalid aggressive pullback is when price distributes in a compression. So here you have your shelf, and this is the distribution outside of your shelf, which is compressive. So now if you do have an aggressive pullback, expect your premium to fail and price reach for external liquidity. So here you have your shelf, and this is your order block. Now you have an aggressive distribution outside of your shelf. So what do you expect your pullback to be? Pullback should be an aggressive pullback. Why? Because the cells need to be balanced. This is a volume gap. This volume gap needs to be filled with buy orders for the purpose of balancement. Do you expect an aggressive pullback? So let's locate our shelf. This would be our shelf right here. And what kind of pullback would you anticipate back to this shelf? If you guessed aggressive, you are correct because the breakaway here was aggressive. So you would anticipate an aggressive pullback. And here you had an aggressive pullback. So again, going back to our first example, you can see this aggressive move away from the shelf. This will be an aggressive distribution. So even though price did cover some of the distance, as you can see right here, price did retrace, you still have a volume gap because of the aggressive distribution. So when price did reach this level, you can see an aggressive pullback, even though, yes, initially you did have a compressive profile, but once price reached this level, price had to balance out and close this sell-off. So this sell-off had to be met with buy orders. So let's talk about early signs of a change of character. So let's say you are in a bullish trend. And currently you are in a bullish trend and price keeps retracing back to your extreme. So now price consolidates again, but this time for much longer, maybe forming a Wyckoff, maybe forming a Wyckoff, maybe pulling out externals on both ends, whatever the case may be. Understand that this accumulation right here took much longer time than this accumulation here and this accumulation here. What does that mean? What happens when the market accumulates? That means orders are getting injected. Orders are getting injected. So when price does retrace to this level, this is a low probability buy. Any buy right here would be a low probability. Why? Because this could more than likely be a change of character and price starting a whole new trend. So let's mark up our range. So here we have our swing low and swing high. And let's mark up our point of interest, which is our discounted zone. This will be our extreme discount. And now that you've been through this lesson, tell me why this trade is invalid and why this trade will more than likely fail. Look how long price consolidated here. Look how long price consolidated here in comparison to even this consolidation, and even this consolidation before your pullback. So these pullbacks, look at the previous consolidation prior to this. This one is much longer. And you could, when you see this, a lot of times this is a change of character. So you don't want to get caught in a change of character. As you can see, this is very similar to a longer consolidation in comparison to all the previous consolidations. And you can see the same thing here. This consolidation is much longer than the previous consolidations. And an easy way to go about this, if you don't trust your eyes, you can always pinpoint your measuring tool and you can measure the consolidation. So this consolidation was 67 bars, so 4 days and 19 hours. And you can measure it to the previous consolidation. There's no match. Previous consolidation, this consolidation ended right here. And this consolidation right here. This consolidation is much longer. So this tells you that this might be a change of character. So let's talk about external PA. So say this is your structure. And here you have your shelf. This is the pullback that you're currently anticipating. And your speculation here is a retracement for a rejection to continue the bullish trend. Now, the part that a lot of traders ignore is the overall macro structure and understanding the parent range. So what would be the parent range? It's your macro structure. Your macro structure is this swing high and this swing low. And why would a trade right here be dangerous? One, you're buying at premium, which doesn't make any sense. Buying at premium. There is certain instances when you're looking for a hidden block, but for a regular pullback, you are not looking for a buy at an external level. What is external? Outside of the range. So you're currently outside of the range. And why would this be a low probability trade? Because price could always reference this macro range. Price could always retrace all the way here, all the way to the discounted zone right here for the institutions to buy price at a cheaper rate and continue the overall macro trend. So let's talk about the parent range. So you can see here that you would be looking to purchase price right here. This would be your shelf. Obviously on a lower time frame, on the 15-minute, you would see that this is your shelf, and inside of this shelf there's probably a 15-minute order block right here. But let's just focus on the 1 hour order block, which is also your shelf. Understand where you're purchasing price. So sure, this is a bullish trend, but once you zoom out, understand that you took out major liquidity. You took out higher time frame liquidity. So let's say you go to the 4-hour time frame, you would have a better view that price took out this high. So what's the low referencing to this high? It would be this low right here. So buying price right here is always dangerous because price could always come back inside of this macro range and now reference this range. So buying price right here is dangerous. Why? Because price could always be incentivized to come back inside of the macro range and now reference this range and head to the extreme here to then or start a new structure and start the process again. So let's go back on the 1 hour. And not saying that this wouldn't work all the time. It will work sometimes, but it's just probability wise, it's just not smart. Buying or selling price at external. So buying price at buy side and selling price at sell side. It just, for sure, it gave you a few points, but now price is back now referencing the parent range, which is your macro range. So yes, even though here you had a range right here, understand that now price is referencing the parent range, which is the macro. Hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, and let us know in the comments what lesson do you guys want next.